I want to show you guys a couple examples of how cap rate affects the value of a property. Real estate lab. What's up, guys and girls? We are going over cap rates in this section more in depth. I talked about them a little bit in the last section. I want to go over more in depth now and show you guys the equation, the three different scenarios where it is utilized, three main scenarios where it's utilized. And then also, I want to show you guys a couple examples of how cap rate affects the value of a property. So just high level, what is a cap rate? A cap rate is a percentage, normally in the realm of a couple percent up to 10, 12%. You're normally not going to see cap rates much higher than that. Right now, in today's market, cap rates are very commonly between the numbers of 5 and 7%, right? Let me just give you the high level range. There's a lot of changes that can happen, but that's kind of where we're sitting today. So it depends on a lot of factors. Depends on the market you're in, a lot of things. But first, I got to explain what a cap rate is. So, couple definitions. One, what is the equation for valuing a property, which is what we utilize cap rates for. So, you are going to take the net operating income, divide by a cap rate, and you're going to get the value of the property. There's a couple different types of cap rates. So, I'm going to show you a couple different types. So, excuse my handwriting. It's not the best, but I'm sure you guys will hopefully be able to read this. So, a market cap rate. First type of cap rate. Market cap rate equals average of cap rates. Average of transaction cap rates in a specific market. Okay, so market cap rate, and I'll show you how to use the market cap rate, but the market cap rate is the average of a bunch of different transaction cap rates in a specific market. This data is there's no standard for what the market cap rate is. A lot of people try to aggregate this data as best they can, and they come up with pretty close averages for what market cap rates are. But market cap rates will differ depending on what location you're in, what city, what state, what metro area. Also, what type of property. Do you have a Class A property, or are we talking a Class C property? The nicer the area and the nicer the property equals a lower cap rate. Maybe I could put that. Let's put a little scale here. Oh, got to get my pencil back out. So we've got this high cap. Let's say 8 to 10%, because that today is a pretty high cap rate. Low cap rate, 3 to 5%. 3 is unbelievably low. Each percent makes a massive difference, by the way. So, and we talk about these with decimal points, 5.2, 5.5, 5.7, right? So these are different, but low cap rates, 3 is unbelievably low. Let me put 4. But, we're seeing 3 caps in certain markets, like in Austin, Texas, Los Angeles, maybe not as much New York anymore, but Florida. We're seeing really low cap rates. So high cap rates. Let's put a little line down here. High cap rates, bad areas, bad location, C and D class location, older properties, right? And C and D properties. So you combine these things, the cap rate begins to get higher. Why is that? Because you're buying riskier properties. buying properties in undesirable locations. And so those properties will actually have higher returns. The higher the cap rate, the higher the cash on cash return on investment. However, that sounds great. That's not always a good thing. If you told me, hey, Dave, you can go into the hood in Detroit, which, by the way, I've spent a lot of time in. I went to school there. And you could buy a 10 cap property. Would you do it? Hey, that sounds great. It's a high cap rate. Remember the rule. You want to buy high, sell low. I would not do it, though, because it's in a bad area. That area, I would buy it at a high cap rate, and eventually I'd have to sell it at a high cap rate. Our goal is, let me put a line across the screen. The goal. What is the goal? The goal is to buy at high cap rate and sell at low cap rate and increase the NOI. I'll show you why, and that rhymes. I'm going to erase that because that was just so bad. You know, it's not always easy writing on these iPads, but it actually is pretty solid. I just have terrible handwriting because I type all the time. So, high cap rate. Low cap rate. Nice location. High demand from buyers. A and B areas and properties. A and B areas, A and B properties. All right. So we're talking high quality properties have lower cap rates. Why is that? Because they're more stable, because they're nicer, right? So every dollar of NOI gets you a nicer property. I could have two properties that both have a net operating income of, remember, NOI divided by cap rate equals value of property. The lower of a percentage that you divide by, the higher of a number you're going to get. I'll show you an example here. I don't have a quick calculator here, but I'll show you a bunch of examples. Give me a second to write down some examples. But to explain that concept, you could have two properties, one in downtown Austin, Texas, and one in Detroit. I'll use these because I grew up in Michigan, in Detroit, Michigan, and I now live in Austin, Texas. And they're two wildly different markets, as I've talked about before. So in Detroit, I could have a property that's, let's say it's 30 units, and its NOI is $50,000, right? 30 units, NOI is $50,000. I could have a 30 unit in Austin, Texas, and the NOI is $50,000. Which one is worth more? Well, it depends what the market cap rate is. If somebody is willing to pay more for the same property, the same NOI in Austin than in our Detroit, it's going to yield higher or lower market cap rates. For example, that $50,000 property, if sold in Detroit at an 8 cap, is valued at $625,000. So, Detroit, 50K NOI divided by the market cap rate of 625,000, divided by the market cap of 8% equals $625,000. In Austin, somebody is willing to pay significantly more for that same property just because it's Austin. So we have a 50K net operating income minus expenses, remember, is NOI, divided by somebody's willing to pay a 5% cap rate. $50,000. The properties make the exact same amount of money, guys. $50,000 NOI divided by 0.05, $1 million. It could be in the exact same condition. It could have the same tenants, the same rents. In Austin, it's a much higher demand market. It's a nicer market, higher quality market, right? They could be in similar types of areas, But what's different in this scenario? It's the cap rate. It's the market cap rate. So now that you've seen these two different scenarios, why is the market cap rate lower in Austin? The market cap rate's lower in Austin because of higher demand. Higher demand, higher growth market. It's a very hot market. People are paying significantly higher prices in Austin because of the supply and demand than they are in Detroit, right? That's the basis of it. It's supply and demand. So when we're talking about market cap rates, we said it, the average of transaction cap rates in a specific market. So if I take the same property in Detroit and the same property in Austin and I sell it 50 times over and over and over, some might sell in Detroit at a 7, a 7.5, an 8, an 8.75, an 8.25, right? But it sells over and over again. We're going to get a market cap rate of 8%. Let's just say that's what it is. So I'm gonna have a couple examples here. And let's say we're talking about just a B-class property to keep for this whole example, all the examples here to stay consistent. We're talking about B-class properties, right? So Detroit, market cap, 8%. Austin, market cap, 8%. Or sorry, 5%. Come on, man. 5%. All right. So market cap rates, the aggregate or the average of transaction cap rates in a specific market. So these cap rates, these are not exact. I'm just pulling these out, right, for example purposes. But these cap rates are determined by, hey, there were 600 multifamily properties sold in Austin last year. Let's look at every purchase price, every NOI, and we're going to average out the cap rates for different classes of properties. And there's no, like I said, there's no one source that does this perfectly, but there are a lot of different sources on the internet that try and aggregate these sale prices. CoStar is a really good one. They have a lot of data on this type of stuff. And then the more you look at markets, the more you start figuring out, you talk to brokers, the more you figure out what, transactions, the normal cap rates are for certain types of transactions and certain classes of properties. So, again, market cap rate. How is the market cap rate found? Let's show that again. If a 50,000 NOI property is bought for $1 million, that gives us this cap rate of 5%. Okay, so that's one way that we find cap rates. Finding market caps. Let's see. Market. We just reverse engineer this definition. Market cap rate equals NOI divided by purchase price. Or this is actually, transaction cap rate. Transaction. This is the cap rate that you bought this property for. What was the NOI when you bought a property? And how much did you pay for it? That gives you a specific cap rate that you bought the property for. Oh, I bought it for a 7.65 cap. That was the cap rate that you bought the property for. That does not mean that's what the market cap is. So let me give you an example right here. Let's say that this same property in Austin I bought for $750,000. The market cap is still, let's talk in Austin, for all these examples, our market cap is 5% in Austin and it's 8% in Detroit. So let's do an Austin example. In Austin, I bought a 30 unit in Austin for $775,000. And NOI was $50K. All right. That means, what was my transaction cap rate? I have two parts to this equation. There's only three parts in the NOI equation, no matter how we frame it. Right? NOI divided by cap rate equals the value of property. Cap rate is equal to NOI divided by the value of property. Right? We just reverse engineered the equation. So, we are going to take the NOI divided by the purchase price, and we're going to get the transaction cap rate. 50,000 divided by 775,000, 6.4%. So let's take this equation right up here. 50,000 divided by 775,000 equals 6.45% cap rate at purchase. Now, here's the magic. If you bought this property for a cap rate that's above the market cap rate, that means you're in the money. That means you bought a good deal. You don't want to buy below the market cap, except for in another scenario I'll show you in a little bit, right? This property that you bought at a 6.45% cap rate today is worth, I'll show you, today that property is worth this, right? So this is what we bought it for. This is what it's worth today, right? Because the cap rate in this market is actually 5%. So we're going to take 50,000, and now we're going to use this top equation. NOI divided by cap rate equals current value of the property. 50,000 divided by 5%. I'm going to erase that. Divided by 5% equals 50,000 divided by 0.05 is $1 million. I bought this property for $775. Day one, because the actual market cap in Austin is 5%, it's worth $1 million. All right, it's fantastic. So we've established here, if you buy at a better cap rate and the market cap rate is actually lower, your property is worth more than what you bought it for. You do not want to do the opposite. You do not want to buy a 4 cap when the market is willing to pay a 5 cap for it. And when I say the market, I'm saying all the buyers out there. So you want to buy at a high cap rate, sell at a low cap rate. So that's one scenario. Here's another scenario. This is how you can add value to a property or buy a good property. You're buying at a high cap rate when the market is willing to pay a lower cap rate for it. I just show you that example. Here's another example. All right, let's go back to Austin again. Let's say, same scenario, 30 unit in Austin with 50K NOI. And I bought it for $1 million. Buy a 30 unit in Austin with 50K for $1 million. Obviously, we've gone over the scenario. That means we bought it at a 5% cap rate. Let's say we increase rents. $100 per unit per month. So our NOI is going to increase. 30 units times $100 equals $3,000 times 12 months equals $36,000. So now our NOI is 50,000 plus 36,000 equals $86,000 NOI. All right. So we have bought this property for $1 million with a $50,000 NOI. This is how we add value in commercial real estate. We're going to take this cap rate example. So we bought it at a 5 cap and we're going to sell it at a 5 cap. What has changed now in this equation? If we look at this equation, what's changed? Our NOI has changed. So now our NOI is $86,000. We're still at a market cap rate of 5%. We could sell the property for a 5% cap rate. What's the value of the property now? $86,000 divided by 0.05. $1.72 million. Guys, all we did was take the, I'm going to rewrite Sorry, I hate my handwriting. All we did was we took these 30 units and we increased the rents by $100 a month per unit. We took them from $900 a month to $1,000 a month. And maybe we spent $100,000 to $200,000 to do this in terms of renovations, right? So if we did that, we spent $100,000 or $200,000. We're all in at $1.2 million. Now it's worth $1.72 million. Crazy, right? So that is the power of increasing rents, adding income. Or, as you guys know, NOI is income minus expenses. If we reduce our expenses, our NOI goes up as well. So, same cap rate in the market, we just made a bunch of money. Now imagine, let's go back. If we bought the property, look at this. If we bought the property for $775,000, like we said here, we bought the property for $775,000 at a 6.45 cap rate. Market cap is 5. We increased the rents by $100 a month. We bought it for 7.75, and now it is worth $1.72 million. So not only did we add value by increasing the rents, but we bought it at a cap rate above market cap. So we did both, right? You could do one or the other, but the best scenario, what did I say the goal was? Buy at a high cap rate, higher than the market, and sell at a low cap rate, and increase NOI. This is money. This is how I've made money. I'll start 3 times because this is how I've made a lot of money in real estate in my career. Is I buy a good deal. I buy it right. I buy it at a low price, which gives me a higher cap rate. I increase the NOI, and I double the value. I mean, I don't always, I have doubled the value quite a few times by doing this method. You buy at a high cap rate, you increase NOI, and the value is exponentially higher. In this scenario, this is not unrealistic to buy a property for $775 and it's worth more than double. I mean, it's a really unbelievable deal, but it's happened before. I bought a property. I'll show you an example. I bought a property. I'll change up the color here. Royal Oak, Michigan. $20 units. The NOI was, oh man, what was the NOI? Was it 80,000? The NOI was, let's say, I think it was like $95,000. Market cap in this area is like 5.25% for this type of property. I actually think it's lower, but let's say 5.25% market cap. I bought it for $1,380,000. All right, so what's our purchase cap? Let's see if we can do the math faster than I can type. Purchase cap. $95,000 NOI divided by 1.38 million. 6.88%. So already we are in the green because I bought it for higher than what the market cap is. I paid 1.38. The market value of this property, the guy probably should have sold it. I'll write it up here. Seller should have sold for $95,000 divided by 5.25%. They should have sold it for this. They should have sold it for $1.8 million. But they didn't because I negotiated a really good price because they weren't really aware of what they had, and I got a great price. And that's called finding a good deal. So I did the first thing. I bought it for $1.38 million, which was a phenomenal deal. There was a couple $100,000 in equity day one. I raised the NOI. Let's say this is, I'll delineate this. This is a purchase NOI. That's the purchase NOI. I stabilized the property. Like, I improved it. I brought it up to market rents. I increased the rents unbelievable amount in this property. My new market rents are about $1,500 on average at this 20-unit property. Times 20, times 12. My expense ratio is about 40%. My new NOI is right around $200,000. And I think it's about to be over $200,000, which is, I mean, I've doubled the NOI. That's crazy. This is a crazy example, by the way. This property we've absolutely crushed it on. So I bought it for 1.38, which is a higher purchase cap. I increased the NOI, right? So we're talking about increasing the NOI here. Let me pull out my little check mark. Boom. I increased NOI. All right, I increased the NOI. So I've done the two things that I told you should do. Now watch this. Watch the value of this property is worth. This is crazy. So my NOI is now $200,000. Oh my gosh, what have I done? How do I get back here? Okay. The NOI of my property is now, what's the equation, guys? It's NOI divided by market cap equals market value. So I took my NOI, my new NOI of $200,000. I divide that by 5.25%. And, drum roll please, 200,000 divided by 0.0525, $3,809,000. And you know what? I just got this property appraised for a refinance, and it appraised for over $4 million. So we're pretty close. This property that I bought, I mean, this is like, I gotta give it 2 check marks there because this is a good deal. I bought it for 1.38, and it's now worth $3.8 million. I've tripled the value of this property in under 2 years, by the way. This deal is a crazy deal. This doesn't happen all the time. This is a crazy deal. This is probably the best deal I've ever done value-wise. It's a smaller property, but tripling the values, this is the first time I've ever tripled the value of a property, especially in that short of a time period. So that is an insane example. Now, I'll give you guys a twist because markets change. What does market changing mean? Markets change means market cap rates change. Over the past 5 years, cap rates have gone down and down and down, meaning the value of properties has gone up and up and up. So let's say you bought a property and the NOI was $95,000 and you sat on it for 5 years. Well, in Royal Oak, Michigan, 5 years ago, the market cap rate was 7.25%, or 7%. The cap rates have gone down closer to 5%. So just by sitting on that property, you didn't even have to increase it. You could have, your value of your property would have gone up a ton just by sitting on it. Now, our cap rates are really low right now. When cap rates are really low, it only takes a few variables in the market for cap rates to start going up again. So we're in a position right now where we have to add value to the property. We have to increase our NOI, guys. So one of the things, like I said, the rule was, this is our goal. The goal is to buy at a high cap rate and sell at a low cap rate. So let me show you a little diagram right here. Let's say these are the cap rates. 8%, 7.5, 7, 6.5, 6, 5.5, 5, 4.5, 4. All right. Let's say, got to pull up my handy dandy little controls here. Let's say that this is the line for market cap rate. Actually, let me undo that. I'm going to say this is the line for market cap rate. Right there, you're paying market. To make money in real estate, I'll tell you this right now. This is the rule. To make money in real estate, you want to buy here. This is where you want to buy. You do not want to buy here. If the market cap rate is there, you do not want to be buying any of this. If you want to crush it in real estate, you buy at high cap rates, higher than the market. This means you're getting a good price. This means you're not overpaying. Anything in here means you're paying market value, right? That's market value, or you're overpaying for any of this. We don't want to do that. We want this. This is it. This is the money. This is how you make money in real estate. This is how I've been wildly successful in the past 6 years, is because I've bought at good prices compared to the market. And that's what you have to do. You have to buy at good prices. The second rule. So I'll put it in. Rule 1. Buy right. Buying right means you buy at a good price, a better price than what most people will pay for it. This means you're not just going on the market and finding whatever deal and paying what they're asking. You're going out there, you're negotiating good prices, you're offering lower than what people are asking, you're getting them down in the price, and you're buying it at a price that nobody else could get that deal for. And a lot of times it happens when you find a property that nobody else is looking at, which we call an off-market property. So, rule number 1. Rule number 2, always add value. You can add value in a bunch of different ways. You can add value by increasing rents. You can add value by charging other income in other areas, charging back for utilities, charging pet fees, charging late fees. You can add value by reducing expenses. All these things increase NOI. Increase NOI. Because as you guys know, I've showed you examples, the higher the NOI gets, the higher the market value. If the cap rate stays the same, that's great. Even if the cap rate goes up, and this is why this is rule number 2, and why this rule is so important. Obviously, you have to buy right, but let's say you buy right and the market shifts. Let's say you buy it for a 7 cap. What if this line changes and the market changes and now you're at market value? Now you have no equity in the property, right? Because the market's gone down. Cap rates have gone higher, meaning the value of your property is being reduced. The market was really hot and it was worth, this could happen to me right now. It's worth 3.8. Let's say the market crashes in Royal Oak, Michigan. Now properties are trading at 6.5 caps, 7 caps. The value of my property is now going to go down. But at least it's not going to go down to less than what I bought it for because I've increased the NOI. And so even if it sells at an 8 cap, $200,000 divided by an 8 cap is still $2.5 million. If I left it at $95,000, I didn't increase rents at an 8 cap, it'd be worth $1.2 million. I'd be losing money if I had not increased the NOI and the market cap rate has gone up because the market crashed or right, this area has gone downhill or something happens, which is unlikely because I pick good markets. It's part of our plan is picking good markets. But because I buy right and because I always had value, I can take hits in market values, in cap rates going up. I could take those hits because I have planned ahead and I've planned right. So those are the rules with cap rates. The last thing with cap rates, right? I told you there are 3 ways. There is the purchase cap rate. So what cap rate did we buy it for? There is current market value. So purchase cap rate equals NOI over purchase price. Current market value equals NOI currently divided by market cap rate. Lastly, projected market value equals erase that. Projected market value equals projected NOI divided by and I'm going to say this twice, conservative market cap. Normally when I'm projecting, so let's say I bought a property, 95,000 NOI. When I bought this property, I projected I was going to get my NOI up to about 160,000. And I projected the market cap was 6% because I was being conservative. I'm not going to say 5% or 4%, right, and overestimate. I'm going to be conservative. So projected market value. So this is how we can estimate the future value of a property. Before I even buy a property, I can estimate what I think it'll be worth when I'm done renovating and improving it. And I can do that by saying, hey, where do I think I can get my NOI to? And what do I think the market cap is going to be conservatively in a 3-year period or a 5-year period? And I can do this using the spreadsheets that I'm going to show you guys how to use, right? This is bringing it full circle. What are we buying it for? What can we get our NOI to? And what cap rate can we sell it for? That's going to give us our projected market value. Lastly, you could find out NOI. Obviously, this is just algebra, guys. So we have an equation. You could find your NOI by multiplying the purchase price by the cap rate. Purchase price times cap rate equals your NOI. I don't really use that much, but just you could reverse engineer this equation in any way you want. 3 variables. As long as you have 2 of the 3 variables, you could find the third. Basic algebra. So, guys, this is cap rates. Cap rates are very important to know. Don't base every decision off cap rates, right? Obviously, the financial models and the underwriting models that I'm going to show you guys how to use are much more comprehensive. They take into account a ton of different factors and give us the most accurate picture on what to buy a property for. We don't want to just take an NOI of a property, divide it by the market cap, and say, hey, I know I can pay that price for that property. Or take the NOI of a property and say, and cap rate, market cap rate plus 1% and offer that, right? You don't want to just make offers based on cap rates. But it is something that you guys need to understand. It helps us project. In the end, this is what we use it mostly for. It helps us project market value out in the future. And it helps us understand, are we buying this property at a good price or not? I'll get into more examples, but you can actually buy a property at a really low cap rate if this is the scenario where it's okay to do that. 1, if you can add an immense amount of value. So let's say the same property, the NOI was $25,000, but I knew I could get it to $200,000. The NOI was $25,000. 25,000 divided by 1.38 million is a 1.8% cap rate. If I saw the same property 2 years ago when I was going to buy it, and they had mismanaged it so terribly that the NOI was actually $25,000, I would buy that property at a 1.8% cap rate, which is in the no-go zone. I said not to do it. But you know what? I would do it if I was super confident that I could take the NOI up to $200,000 because I know I could have brought that property value up to $3.8 million and I'd be in the money. So you can break rule number 1 if it is a non-stabilized property. You can break rule number 1. I'll write here. Exception is if property is unstable, meaning that the rents are low, high vacancy, right? Maybe only half the units are full because they're not leasing up units because they just don't give a fuck. Exception is if property is unstable and has potential for high NOI increase. Rule number 2, always add value. I try to never break that rule unless you're buying something turnkey at a really high cap rate. That's the only reason why you could break rule 2. So, but you need to at least have one of these. The goal is to have both. I make it a rule for me to have both. And that's why I have a track record that looks like my track record because I've had both of these on every property I've ever done. I have both of them. And that's why I've got a good track record. So, rule number 1, rule number 2. Hopefully this was helpful for you guys. Hopefully you understand cap rates at this point. Really important concept. Now we're going to get into some more actual practical and tactical examples. I call this next section the fundamentals of underwriting because I'm going to show you guys what we first went over with the key definitions and the income statements mixed with some of this cap rate stuff. And we're going to get into an actual example of a pro forma and what that looks like. And then after that, we'll get into a more in-depth pro forma and show you guys how we utilize our software to underwrite deals.